The year is 2025. The markets are electric with excitement. AI stocks are skyrocketing like never before. Bitcoin is breaking all records. Even meme stocks are making a comeback. It feels like a golden age of prosperity. But are we standing on solid ground? Or dancing on the edge of a volcano? History is littered with market manias, times when optimism knew no bounds, when prices soared far above their true value. And these periods often ended in disaster. Yet every time people believe it's different. Are they right this time in May 2025? Or are we repeating history? Is this boom real and sustainable? Or just a bubble waiting to burst? The stakes couldn't be higher. From Wall Street giants to everyday investors, let's dive deep into this thrilling puzzle. Artificial intelligence, or AI, is the talk of our times. Stocks related to AI are soaring. Companies promise revolutionary technologies. They say AI will change every industry, transform how we live and work. Investors are pouring billions into these dreams, hoping to catch the next big wave. The enthusiasm is truly infectious now. A belief in a transformative future. It is driving markets to new peaks. Yet the valuations are extremely high. Some AI companies have little revenue, or no profits to show yet. Still, their stock prices multiply rapidly. This reminds many of the dot-com era. Back then, internet companies also promised wonders. Is the promise of AI more real this time? Or are we seeing a similar speculative fever? The past offers us cautionary tales. Consider the companies making AI chips, or those developing complex AI software. Demand for their products is intense. A perceived scarcity drives prices skyward. Narratives of endless growth dominate conversations. Bitcoin has captured the world's imagination. Its price has surged to $110,000. The excitement is palpable, truly immense. Many now see Bitcoin as digital gold, a new store of value for our age, a hedge against inflation, they claim, or a safe haven in uncertain times. Proponents believe it's the future of finance, a decentralized currency free from government control. This narrative has powerful appeal to many. Comparisons to gold are made constantly. Gold has been a store of value for millennia. Bitcoin, its supporters argue, is similar, but it is digital, modern, and borderless. They point to its limited supply. Only 21 million Bitcoins will ever exist. This scarcity, they say, ensures its value. But is this comparison truly accurate? Or is it a convenient story? Others, however, offer a stark warning. They point to historical speculative manias, Tulip mania in 17th century Holland. The phenomenon of meme stocks is back. Shares of companies like GameStop and AMC are experiencing sudden, dramatic surges again. This is largely driven by retail investors, often coordinating on online forums and social media platforms like Reddit. It's a unique feature of today's markets, a new kind of collective investor action, challenging traditional Wall Street dynamics. Their power is surprisingly strong. This is not primarily about company fundamentals, the usual metrics of profit and loss, or long-term business strategy. These often take a back seat here. Instead, it is about market sentiment. It is about creating short squeezes, forcing hedge funds to cover their bets. And sometimes it's about a narrative, a story of David versus Goliath, the small investor fighting the establishment. Social media acts as an accelerant. Information and misinformation spreads like wildfire. The fear of missing out, or FOMO, becomes an incredibly powerful force. Seeing others post huge gains is tempting. Many jump in, fearing they'll be left behind. 5. Echoes from the past. The dot-com bubble revisited. Do you remember the late 1990s? The dot-com boom was in full swing. New internet technology promised to change everything. Optimism was boundless, truly endless. It felt like a new economic paradigm. Does this narrative sound familiar today? It should as we look at 2025. The parallels are quite striking indeed. History may not repeat exactly, but it often rhymes, as they say. During the dot-com bubble, many companies soared, even those with no profits or no clear plan. Any firm with .com in its name saw its stock price multiply rapidly. New economy thinking was dominant then. Old valuation rules were dismissed as outdated. Then the crash began in March 2000. Trillions in market value vanished. Many dreams of instant riches were shattered. It was a harsh lesson for many investors. What similarities do we see today? Section 6. Lessons from 2008, when the housing market cracked. The financial crisis of 2008 was different. It did not start with technology stocks. It began in the housing market, fueled by subprime mortgages given widely and complex financial products few understood. These were called mortgage-backed securities and collateralized debt obligations, or CDOs. The complexity hid enormous risks. This led to a devastating global impact. The lessons learned were painful and deep. But even with these differences, common threads exist. A core belief in ever-rising prices, for housing in that specific instance. Cheap credit and easy money fueled the boom, making it easy for people to borrow. Widespread systemic risk built up silently. Many institutions were exposed, interconnected. When one part failed, it spread quickly. Section 7. The fuel of bubbles, tech euphoria, cheap money, and FOMO. Tech euphoria is a remarkably powerful force. Artificial intelligence as a concept seems like magic. It promises to solve immense problems, to revolutionize industries, to change our lives. People readily believe in these grand visions. This belief creates excitement and optimism. It makes high valuations seem justified. The narrative of a better future, powered by technology, is very compelling. This is a core ingredient of bubbles. For many years, money was cheap. Interest rates were kept very low by central banks around the world. This made borrowing easy and inexpensive. A flood of this cheap money chased higher returns in riskier assets like stocks, and especially growth stocks. Even if rates have risen by 2025, the legacy of that long period remains. It has conditioned investor expectations. Then there is FOMO, fear of missing out. Section 8. Cracks in the foundation? Warning signs of instability. What are the potential warning signs today? Extreme valuations are a key indicator. Stock prices far above historical averages, especially when measured against company earnings. Are profits truly keeping pace with prices? Or is there a growing disconnect? This gap can signal an unstable market, a market built more on hope than reality. Such situations rarely last forever. A return to fundamentals is often painful. We see high levels of speculation. Many people are buying assets that they do not fully understand, hoping for quick and easy profits. The get-rich-quick mentality is widespread. This is often visible in social media trends and in the popularity of very risky trades. When caution is thrown to the wind and greed becomes the dominant emotion, that is a classic sign of a late-stage bubble. Market concentration is another concern. A significant portion of overall market gains has been driven by a few very large and very successful technology stocks. This creates a vulnerability. What if these market leaders stumble? If their growth slows or they face problems, the impact on the broader market could be severe. Diversification of the market's drivers is generally a healthier sign. We must also consider external factors. Geopolitical risks remain elevated worldwide. Section 9. Navigating the tightrope opportunities amidst the froth. Despite the risks, not all is doom and gloom. Real, tangible innovation is indeed happening, especially in the field of artificial intelligence. Some companies will undoubtedly succeed spectacularly. They will deliver real value and growth, transforming industries and creating new ones. The challenge is identifying these true winners amidst the general market froth and hype. This requires careful research and discernment, not just following the loudest voices. Bitcoin and the broader crypto asset class may also find a lasting role to play. Though still highly speculative for many, the underlying blockchain technology has potential for new financial applications and systems or for other forms of digital ownership. The journey to maturity will be volatile, but dismissing it entirely might be short-sighted. Again, understanding is key before investing, and only risking what one can afford to lose. In such uncertain times, diversification is vital. It is a fundamental principle of sound investing. Do not put all your financial eggs into one single speculative basket, especially not the riskiest one available. Spread your investments across different assets, different sectors, and different geographies. This can help cushion against losses. Section 10. Conclusion. Prudence in an age of exuberance. The financial market of 2025 is captivating. It offers dazzling prospects for wealth creation through AI stocks, cryptocurrencies like Bitcoin, and even the surprising meme stock rallies. But this excitement comes with significant risks. The potential for big rewards is clear, but so too is the danger of big losses. It is a landscape of high stakes and requires a very clear-headed assessment. This is an age of exuberance. We see undeniable echoes of past bubbles, the dot-com mania of the late 1990s, even some behavioral patterns from before 2008. Human psychology is a constant in markets. The power of compelling narratives is strong. Euphoria can easily blind us to emerging risks. The belief that this time is different is a siren song that has lured many onto the rocks of financial ruin. History provides us with valuable lessons. How then should smart investors behave? They should strive to stay grounded amidst the surrounding frenzy and excitement. They seek knowledge and understanding. They carefully manage their risk exposure. They avoid the madness of crowds that can sweep through financial markets.